I'm Joe Werbick, Certified Financial Planner.
And I'm Doug Harding, and this is Retirement, Everything They Never Told You. And Joe, we're going to talk about some interesting words, should I say, about finance here in just a little bit. But I want you to catch us all up on what is going on right now with the market. I know there's a lot of stuff going on. I want you to explain.
There is a lot of stuff going on, Doug. It's a good question. What is the stuff going on in the market? Well, it's 2026. It's a new year, so we're looking at it. We want to know, how is the market going to behave in the first few days of a new year? Because that can kind of give us an insight to what the rest of the year's going to be like.
Okay.
And so far, it's been good. We have all three indices positive. They've been up a little bit more aggressively than I'd like to see. Mm-hmm. But it's better than being negative more aggressively than I'd like to see. So 2026 looks good. I said this last year. I said, remember, whenever you have an interest rate cut, right, you typically have a 13 to 18% increase in the S&P 500 over the next 12 months. Okay. So we had interest rate decreases. Did I say increase or decrease?
You said decrease.
Good. Sometimes, I forget the word I said. So we had decreases last year, November, 0.25%. And, we're getting a new Fed chairman this year.
That's right.
It's pretty exciting stuff.
Mm-hmm. Well, Joe, I wanted to talk about retirees, but first off, I have some trivia for you. I want to see how good you are with the market. This is, there's a bunch of different markets, but do you know what the very first market was in the history of the world? I mean, this might be a tough one, but I have a feeling you'll get this.
I mean, I can't give the exact year. I want to say it was the late 1700s, somewhere in Europe.
Okay.
Maybe Amsterdam?
Yes.
Okay.
You got that right. Very good.
And one of the commodities that they traded was tulips.
Tulips?
It was a huge market for tulips. In fact, we saw some stock market crashes in tulips, but interesting.
Okay.
Yeah.
Well, that makes sense because Amsterdam, Holland is famous for their flowers, especially tulips. So I get that.
There's where it comes from. Yeah.
And the year was actually 1602.
Oh, I was off.
Well, you got Amsterdam, right? So
I said 1700, so it's, it's over 100 years off.
But I think, I think you were thinking about the New York Stock Exchange because that happened in 1792. So maybe you got those two confused.
I do tend to get dates, that are 200, 300, 400 years ago confused.
Yeah. Well, I'm sure that our listeners and our viewers were not born back then. But we do have a lot of retirees that watch us and listen to us. So, investing for 2026, I mean, what should retirees be aware of?
Well, when you're a retiree, I think your goals should be slightly modified depending upon what you need your portfolio to do for you. Mm-hmm. Because there's two different main stages in portfolios for investors. You got your accumulation phase and your distribution phase.
All right.
Now, some retirees, maybe their Social Security and maybe they have a pension, maybe those combined give them the income that they need. Then they don't have to worry about their portfolio and they don't go into that distribution phase. But if you're a retiree and you're actually spending your portfolio, that means you're in distribution phase, and you probably want to treat the investments a little bit different.
Okay.
Maybe you aren't trying to be as greedy as you were before. I always tell my younger clients, just don't worry about it. The markets are going to come back. If you're 30 and you're not going to retire till 65, that's 35 years. The market should be up over 35 years.
Yeah.
But if you're actively pulling money from your portfolio and we have a bear market, and the way you're pulling from your portfolio is by selling off shares of either ETFs or mutual funds or stocks.
Mm-hmm.
If you're doing that during a downward trending market, you're going to be selling off more shares to get you the same income. And a lot of times people will say, oh, don't worry, the markets come down. When they come back up, you're fine. But if you're selling out and you're selling larger and larger chunks, when the markets recover, you won't be back to where you were before the decline.
Right.
So you got to really focus on, how am I going to access this money? And the portfolio should be set up a little bit different, I would say.
Okay. Well, this is your job. This is what you do. So, yeah, you would know best. Yeah.
Well, it's hard because I'm one of those guys who likes to say there's, 100 different ways to skin a cat or whatever.
Right.
It's a terrible saying. Who would ever want to skin a cat?
It sounds psychopathic.
It does. Yeah, we need a different saying, Doug. I don't like that. So we talked about income. If you're taking distribution from your portfolio, maybe look for investments that are creating income. Maybe you have stocks that have a high dividend income stream, or you have a bond portfolio that has a nice amount of interest being paid out, and then you're not selling off shares to generate that income.
All right.
We have a private debt fund that gives our clients between 7 and 8% in dividends each year. You're not selling anything. At that point, you're just living off the dividends. And so if you have volatility, it's not going to hurt your income, and it's not going to hurt the value of the portfolio when the markets recover. Which brings me to another point.
What's that?
People talk about diversification. You've heard of that before,
Hear
Doug.
it all the time, yeah.
What do you think diversification means?
It means you have, I guess, stocks, maybe you have bonds, maybe you have a 401k.
Okay.
Am I close?
Stocks, bonds, and 401k. Well, you talked about asset classes and you talked about tax classes. So getting there. Have you ever, sorry, Doug.
I feel so dumb.
Have you ever heard the term non-correlated assets?
I have, but you're going to have to explain that one to me.
Okay. So what we see happens inside people's portfolio is they do what you said. I'm going to buy stocks and I'm going to buy bonds, and I've diversified.
Mm-hmm.
Maybe I'll buy some large cap stocks, some mid cap stocks, some small cap stocks. And just so you understand, cap is the size of the company.
Okay.
Large companies, medium-sized companies, small companies. But what we see is sometimes those companies perform similarly in up and down markets. And then people will buy bonds, but they'll buy bond funds. And a bond fund trades like a stocks fund. I said stocks fund, didn't I?
You did.
A bond fund trades like a stock fund. You know, if you own a bond and you hold it till maturity, you don't care what the value of the bond is while you're holding it. And so you have interest rate fluctuations in bonds, but you don't care because when it matures, you get your money back. But if you buy a bond fund, those bonds are never going to mature because the fund manager is going to be selling them constantly. So your bond fund ends up acting like a stock fund. And so when we talk about correlated assets, when the markets move one way, if everything in your portfolio moves the same way, or when it moves down, everything in your portfolio moves down, then your portfolio is correlated. Okay. A non-correlated asset is the markets move one way and your portfolio does not react in the same manner.
Huh.
And you want it to not react in the down more. So you'd like the whole portfolio to always move up, but if the markets fall, you don't want the whole portfolio to fall. So non-correlated assets.
All right. I learned something.
That private debt fund that I mentioned, that is an asset that's not correlated to the stock market. because it's debt. It's not a stock. So the other problem I see with diversification is somebody will buy 2 or 3 or 4 different growth funds, and they don't realize that those mutual funds are so big that they probably own every stock that's available to be purchased. And then you buy 3 or 4 of those funds, and you're just buying the same stuff over and over and over. So you're not diversifying at all. And the worst investment in my mind, when you mention 401ks, are these lifestyle funds, these life cycle funds. Oh, they drive me crazy.
Why?
Because they offer a false pretense, a false promise. They tell you, pick a retirement date, Doug. And as you get closer to that, we'll reduce the volatility in your portfolio, reduce the risk in your portfolio. But the only tools they have are bond funds. Those bond funds have just as much risk as stock funds, so they can't reduce the risk in your portfolio. So they're offering you a false promise. And I've seen those be extremely negative a year or 2 out from retirement. So making sure you understand what's actually in your portfolio, having somebody do like a portfolio audit and tell you what you have would be helpful, especially if you're in retirement.
Yeah, it kind of seems a little bit confusing to me that all these different bond funds and everything in your portfolio. So that's why you're there to explain all of this.
That's what we do.
Yeah.
But the hard part is getting the people who are watching this to reach out to us and say, hey, do that for us. That's the most difficult part of my job, is trying to convince you, the listener, of what we can do for you, because you kind of don't know what you don't know. And so you've been working with an advisor or a registered representative or a life insurance agent, whoever, and you're happy, but you don't realize how much more could be offered, how much more an advisor, a financial planner can bring to the table. And so that's the hard part, is convincing you guys out there that you should reach out to us. Let us sit down with you, either via Zoom or you come into the office. Let us build a plan for you. Let us show you the difference. And we offer this risk-free. We say, hey, click that link you see on the screen, or call that phone number, or go to www.sequinox.com and set up an appointment. Give us a half an hour and let us show you that we can offer these services for free, just so we can start this conversation. And then once the conversation's over, you can go, oh, I like them or I don't like them. And then you just walk away. Anyway, that's my sales pitch for the first few minutes into this, but let's go on.
Hey, I did want to ask you something about investing. And I know that people kind of get a little squirrely and maybe stash cash away. I want to say, stash it in the mattress. I know people probably don't do that anymore, but...
Oh, they stash it.
Okay.
Yeah. And the mattress might be about as good of a return as some of the accounts they use. I just met with a very successful early 60s couple.
Okay.
Fascinating guy. Just locked in on saving. I mean, this guy had just socked the money away, socked it away. And he was using every option that he knew of, which was his 401k.
Good.
A brokerage account outside his 401k, and then his bank. And he had, which I don't see this too often, he had equal amounts of money inside his retirement plan as outside of his retirement plan. So the issues with his portfolio was, number one, his cash was underperforming.
Yeah.
That's what I think you wanted to talk about with this segment, is if I have money sitting in checking accounts, savings accounts, or underperforming money market accounts, I'm either losing money to inflation or just lost opportunity cost to other investments that could be giving you a higher rate of return without higher risk. The other problem, and I don't know if did we talk about My client with the large embedded capital gains. Have we talked about that in the show?
Oh boy, I don't think so. I don't remember that.
So the other issue that this young guy is going to run into, and I see this with older clients that I purchased companies. What I mean by that is I didn't build their portfolios.
Okay.
So when I build a portfolio, Doug, I try to keep everything as tax deferred and as tax efficient as possible. You know, it's funny. Mm-hmm. I got to remember who I'm talking to because I spent the whole day yesterday recording my television show.
Right.
And every time I wanted to talk to my host on that, I wanted to call him Doug.
Oh,
and he's Brad.
Nice, you got Doug on the mind.
So every time I would look at him, I'd be like, that's not Doug. But now I got Brad's name in my head. So I got to look at you and say, that's not Brad, that's Doug.
Brad and Doug. It seems like there's a musical group or something like that.
Brad and Doug.
We sing the folk hits.
Would it be Brad and Doug or Doug and Brad? Because Doug and Brad has a different feel.
It
that
does.
Feels more bluegrassy.
It depends what genre we're going to go to.
Yeah, it's true. That's
Brad
true. Anyway,
and Doug. Okay.
So this individual that had a lot of money outside of his IRA, he has a few $1 million sitting in a brokerage account. Right. And it's sitting in mutual funds, okay? And he had a great year. I mean, I think we were up, 23%, something like that. Good year. And he didn't sell anything out of that portfolio, okay?
Okay.
So you would think, I have a portfolio of funds. It's not creating interest. It's not a high dividend portfolio. And I didn't sell anything in that. So I really shouldn't be taxed. And let's say he made $700,000 in gains. It's a good year, right? Unfortunately, those fund managers, at the end of the year, they'll do this task called like rebalancing, where they want to get their portfolio back in line with what their stated goals and purposes are. And so that means they may have to sell off some of the underlying investments. So my client didn't sell anything. And about a month before the end of the year, he reached out and said, "Hey, Joe, what did my capital gains look like for this year?" And they were small. It wasn't anything big. But the week before the end of the year, boom, $250,000 of capital gains.
Oh.
Embedded capital gains. He didn't sell anything. He didn't make any changes. But now he's going to have a tax bill of $35,000 to $40,000.
Wow.
It hurts when the markets are up, but that can actually happen when the markets are down. So you could have that portfolio lose money, and they could sell off a stock that has a gain inside the portfolio, and you have to pay the tax on the gain, even though you lost money. So the reason I'm telling this story is because when you're heading into retirement, taxes matter. They matter way more than when you're working. Because when you're working, you should have extra money to pay the taxes. But when you're retired, your income stream is going to be more specific for your needs. And these taxes can really hurt it. A lot of times what it means when you get hit with these taxes, you have to sell off something else to pay the tax. And when you sell it off, guess what that does?
It increases your taxes probably.
Yeah. Yeah. So you owe taxes. You go, oh, I'm going to sell this off to pay this tax. Oh, the tax went off. So I'm going to sell off a little bit more. The tax just went up. But let me sell a little bit more. Oh, the tax just went up. So
you can't win, it seems.
You can't. And so this individual, I would love to redo his portfolio, but because I purchased his portfolio when I bought a company, and he had such large embedded gains already, I couldn't, as a fiduciary, I couldn't say, hey, you should get out of this and just pay those taxes and everything will be okay, because I'd be making a lateral move for performance and I wouldn't be increasing his performance. I'd just be making him pay tax. So I have this younger guy, and I can just foresee what his future is going to look like. Because he has so much money outside of his retirement accounts, if we don't do anything with that money today, in 15, 20 years, he could be hit with hundreds of thousands of dollars of taxes from his non-IRA assets. And then his IRA, Doug, we looked at his required minimum distribution. And for him, it'll be 75. And his RMD, because he had saved so much pre-tax, was 6 figures. So his required distribution would put him into the 35% tax bracket.
That's a lot of tax.
Higher than what he's paying currently.
And he probably had no idea, did he?
He had none. And he thought, hey, I'm not gonna pay the tax now at say 24%. Or 22%, because I know I'm going to retire to a lower tax bracket. So I'm going to wait to pay that tax till I retire. Then what did the IRS do? They said, your RMD date isn't 70. It's not 72. It's not 73. It's now 75. So that means you're older, the portfolio is bigger, and your life expectancy is shorter. So your required distribution is bigger. So what I'm working with this guy is twofold. Let's do Roth conversions because he's in his 60s. So we have a long runway till his RMDs start. And let's start positioning those taxable assets into tax deferred or tax efficient investments. That was a long story, but hopefully I got the point across.
Well, that's the thing is, for the average person like me that is not a financial advisor, all these tax laws and tax tricks, I mean, I'm kind of oblivious to those. Not totally oblivious, but, I would need a professional to help me out with this.
That's a good recommendation, Doug. Maybe somebody else out there would need a professional to help with this. But it goes back to what I said. It's what you don't know. It's like you think you know everything, but there's so much out there because you're going, oh, well, I was told to save in my 401k and I have extra money, so I'm just going to throw it in a brokerage account. And then I should have an emergency fund, so I'm just going to throw that in my checking account. And then that emergency fund gets bigger and you save more there, and then your brokerage account gets bigger and the markets go up and you get these big returns and you're not thinking about taxes in the future. And you go to your CPA or your tax return individual, they're definitely not thinking about the future. They're thinking about today.
Yeah.
And so heading into early part of 2026, anybody out there who's about to get your taxes returned, about to get your taxes done, you're going to go to your accountant, you're going to go H&R Block, they're going to do your taxes and they're going to come back and say, hey, you owe X number of dollars in taxes, but if you put money in an IRA, we can lower your taxes. You have to ask yourself the question, do I want to save money on taxes now when I'm working and I have extra income, or would I rather push those savings off until I'm retired? Because if you put money in that IRA, all you're doing is kicking that tax bill down the road. You're saying to the IRS, hey, can I borrow some money from you? I don't want to pay my taxes now. So let me take a loan out on my taxes and you decide the interest rate in that loan. And then you decide what the tax rate is when I pay it back. So I'm going to quote unquote borrow money from you by putting money in my IRA so I don't pay taxes now, but we'll worry about paying that back later at an unknown date, at an unknown rate, at an unknown tax. Or you could just pay your taxes now and be done with it. And that's the difference between Roth and IRAs. IRA, complete unknown. Roth, we know 100% you will not be taxed on it. No one will be taxed on the growth. Your spouse will inherit the money and your kids will inherit that money 100% tax-free. Another meeting with a great retired military gentleman, and he had a pension in Social Security, had 2 pensions actually, and needed to pull nothing from his portfolio. And it was all IRAs. Mm-hmm. And he didn't even know, he wasn't aware that the Roth, all the growth is tax-free. So he knew Roth was good, but he didn't know how good it was. So I'm showing him how to retire with less taxes. I'm showing this younger guy how to retire with less taxes. So if you're out there watching this right now and you've been saving at a good rate, but you've been sticking it all in pre-tax, or maybe you made the switch from pre-tax to Roth, but you still have a bunch of pre-tax money, or you're retired and you have a lot of pre-tax money that you haven't paid tax on yet, let us show you how to make it tax-free. Let us show you how to systematically use the lowest tax rates in our history with the highest standard deductions in our history to get that money converted.
Hey, just Joe, you love taxes, don't you?
I hate taxes, Doug.
Oh, I'm sorry. You love doing taxes and helping people save money on taxes.
I love helping people do tax planning.
Okay.
I don't do taxes. I don't write trusts. I don't do wills. We're certified financial planners. So we build plans for you so that you hopefully retire tax-free. That's our goal.
Okay. I like
Makes
that.
sense.
It totally makes sense. Yeah. Okay.
Yeah.
Yeah.
And the last thing I think we should talk about with retirees and why having a planner in your life is important is that life changes. Did you agree with that statement, Doug?
Every single day it changes, yes. Never know what's going to happen.
I mean, we have geopolitical events that are affecting your income and your taxes. We have stock market ups and downs. We have Congress who wants to just rewrite the tax laws because what else are they going to do? Why the hell do we have so many politicians? Don't we have enough rules? Don't we have enough laws? Why do we have to keep writing new laws? It's like they have to justify their existence. So they say, hey, let's add more tax laws and let's change it. The point is, life is going to change every day for the rest of your life. So why would you want to build a plan and not update it every year? Why would you want to, Mr. or Mrs. Retiree, worry about any of this crap when you're retired? Let us worry about it. Let crazy people like me, who just geek out over this, who read every article and look at every tax law change and look at the stock market every day, let us handle this for you. I mean, we do it. Our average client pays less than 1% per year to do all this work for you. So, get a plan and then get it reviewed every year. I think that's a good enough recommendation for now for retirees out there.
That sounds good to me. I was thinking about something you were talking about earlier in the segment, but I kind of want to bring this up too. Just kind of a little life thing. Do you like music? Do you listen to music all the time? Is it a big part of your life other than doing taxes or tax planning and retirement planning?
I like music, Doug, but I tend to listen to audiobooks more than music.
Okay.
Yeah.
Okay.
And I use my AirPods to listen to audiobooks.
Okay.
When I'm doing any work, if I'm woodworking, if I'm outside in the yard, if I'm doing any work, I got my AirPods in and I'm listening to a book.
That's interesting. I'm more of a music guy, and I don't listen to too many audiobooks. Huh.
Oh.
But
Audible's made it, not that it's our sponsor, but Audible's made it easy.
But that's great, but you're using the AirPods, and
love the AirPods. Love them.
They sound amazing too, by the way. They've gotten a whole lot better too, because there's this new generation of AirPods and
no string. I mean, think about that. We used to be tied to our devices with these wires, and now they're wireless.
Do you remember when you had the ones with the wires, and then you'd you unplug them from your phone or device or whatever, and you put them down, and all of a sudden they get tangled in ways that you had no idea how they got tangled up that much, and it would take.
Or you forget you're hooked up, and you get that.
Oh, we've come a long way in the past couple of years. But, with this new version of the iPod, something really interesting is happening is they can now translate. Like if you're in a foreign country, because I know you travel a ton, and they probably work out well with you, you can have a conversation with somebody in a different language. And I think that's absolutely amazing.
When I was in the Army learning Korean back in the early 90s, I thought one day there will be a computer that will allow me to talk. It'll direct translate, and then that individual will talk back to me, and it'll direct translate. And we were talking about this, and, it took 30 years, but we're there. It's wild.
Mm-hmm. So I want to do something here, Joe. I want you to be the AirPod translator.
Okay.
Okay. But we're going to do it about financial terms. Okay.
Oh. Yeah, because we tend to use financial terms and just assume that everybody knows what we're talking about.
Yes. And I noticed two of them that you used in the last segment. And,
oh, darn.
Well, no, that's okay. I think people may get it, may not, but let's clear this up because I want you to translate exactly what a fiduciary is, because we hear that word all the time.
Fiduciary. So I feel for the last 30 years, I was always a fiduciary. I'm one of those people who I have to do a good job for whoever I'm working with. It's in me. It's who I am. It's how I'm just developed.
Right.
That I have to do a good job. That I'm going to make recommendations that are best for my client. In fact, when I started Sequinox, that was what I wanted to do. I worked for a company that didn't do that. Like 27, 28 years ago. And they did what was best for them. And I came across a situation where I had to present this older woman with this option. And I did my research and I found options that were really good for her, but they weren't the company I worked for. And I went to present it. And my managers pulled me in the office and said, "What the heck are you doing? You can't sell that. That doesn't make us much money. You got to sell this. This makes us more money." I said, but that's not what's good for my client. Mm-hmm. They said, "We don't care. You got to sell this." And I said, "I'm not gonna, because this is better." And that's when I realized I can't work for these companies. So I founded Sequinox on the idea that I should always do what's best for the client. And I'm probably going to make a little bit less. But over the long term, I'm going to get more clients. I'm going to build a better practice. And I eventually will do okay. Then they came out with the term fiduciary, and then they forced you to do what's right for your client. So as much as I love that terminology, do you know who the most famous fiduciary ever was?
I was going to say Warren Buffett.
No, Bernie Madoff.
Wow.
Sorry. But Bernie Madoff was a fiduciary, and he did not do what was best for his clients. He stole billions. So if you're going to work with somebody, make sure they are a fiduciary. That's at least the first step. That just means that they're required to do what's right for you. And if it turns out that they didn't, they will be held liable for it. Mm-hmm. If you work with somebody who's not a fiduciary, they won't ever be held liable for it. So you want to work with a fiduciary. As a certified financial planner, we are held to the highest fiduciary standards of any financial practitioner today.
So looking for a financial advisor, the word fiduciary should be priority one almost?
Oh, yeah. Why would you work with anybody who's not going to be held liable for that?
Right.
Because you go into that relationship, you don't know if you can trust that person. And they may talk a good talk and they may be doing something inappropriate in the background. If they're a fiduciary, they can be held liable for doing that. So at least you have that recourse, because I can't look you in the eye and tell you every fiduciary will do everything by the book every time. Mm-hmm. But at least you have recourse.
All right. Do you want to translate some more?
Of course. Let's keep going.
Well, you also mentioned this earlier in this show. And so translate exactly what RMD is.
RMD. Okay. So the initials stand for required minimum distribution. And if you put money into an IRA, a 401k, a 403b, a 457, a simple plan, a SEP plan, KEOG, any pre-tax, tax-deferred investment, the IRS says this: you're not paying your taxes now, and it's going to grow tax-deferred for a number of years. And eventually, we're going to get sick and tired of waiting for you to pay your taxes. So we're going to pick an age in the future where we force distributions, and those forced distributions will be taxable at whatever the future tax brackets are based on whatever income you have coming in at that time. So RMD is required minimum distribution, and it means today that if I have a 401k, an IRA, a 403b, whatever, if I turn 73 this year, I have a required distribution. And the math is, I believe it's, put me on the spot here because it keeps changing, Doug. It's 26.4. I'd have to look it up. I apologize. Maybe we'll get him to throw it up here on the screen. That's your divisor. So what they do is they take that divisor, you divide that into the value of that account as of December 31st of the year prior turning age 73, and that's your required distribution. Now, if you aren't 73 by the year 2033, then your RMD age is 75. Except they'll probably change it before then. So
always changing. All right.
Because it was 70 and a half, then it was 72, then it was 73, and now it's 75. And that's all happened in the last 2 years. So yeah, they could change it.
All right. Do you want to do some more? I've got a couple more.
Let's just take one more second on this.
Okay.
Why that RMD is so important. Because maybe you don't want to pull out that much. Maybe you don't need that much income. But they force that distribution out, and it's taxable. And so if you have Social Security, that RMD could cause 85% of your Social Security to become taxable. So let's say you were smart and you maximize your Social Security. You pushed off till full retirement age, you pushed off till 70, and maybe you and your wife are getting $60,000, $80,000 a year, and it's a good income. And if it's just Social Security, it's tax-free. So you got $80,000 that's tax-free. Now this RMD comes along, and the RMD is taxable, and 85% of your Social Security is taxable. So now you just doubled your taxable income. Mm-hmm. So I like to say every dollar in RMDs will be taxed twice. So you want to try to avoid them at all costs. How do you do that? Invest in Roth. If you haven't invested in Roth, do Roth conversions. You don't have to convert the whole thing. Convert enough that your RMD is small enough that it doesn't trigger any tax on Social Security, and your standard deduction wipes it away. If that sounded confusing, no worries. Yeah. Let us do it for you.
Simple as that.
Call the number, scan the QR code, go to our website, sequinox.com, set up an appointment. I don't care where you are in the United States. We work with people in all 50 states. Our planners will develop a written financial plan for free. And then you decide once you get the plan, do you want to work with us or not? And our average client pays less than 1% in fees. It's a win-win. So let's keep translating. I like this, Doug.
Okay. I've got a couple more. Well, you were just talking about Roth, so I was going to have you translate Roth. Convergence, especially.
Senator Roth. Love that man. Hate most politicians, but he's a good guy. So the Roth IRA compared to the IRA says I'm going to pay my tax now. So if I put money into a Roth, I paid tax on those dollars today. The beautiful thing about that is that Roth plus all of its earnings are all tax-free for as long as I live and as long as my spouse lives. And then when we both die, it's tax-free for 10 years after our death. So this could be 25, 35, 45, 50, 60, 80 years of tax-free growth. And there's no required distribution. There's no RMD because the IRS doesn't get paid anyway. And people will say, well, Joe, if the Roth is so good, won't the IRS get rid of it? And I don't think they will. And here's how I know, Doug.
Okay.
In 2026, if you want to do a catch-up contribution, do you know what a catch-up contribution is?
That is, you're catching up on, say you missed out on some Roth conversions earlier in life?
And close,
okay,
but not right. Catch-up contributions are, if you hit age 50, if you're trying to maximize your 401k, which is $24,500 this year, you can do an extra $8,000 catch-up contribution if you're over 50. But if you're 60, 61, 62, or 63, you could do an extra $11,250. Those are your catch-up contributions. It allows you to save more to catch up on how much you need to retire. But the IRS said this year, if you do catch-up contributions and you make more than $150,000 the year before at that same job, you have to do your catch-up contributions as Roth. The reason I'm saying this is people will say, oh, they're going to get rid of the Roth. And I say they're requiring the Roth. They're requiring people to put money in the Roth. They're not getting rid of it anytime soon. That was a long reason why the Roth is here. Sorry.
Well,
I like to back up my statements with facts.
Okay. Do you want to continue talking about Roths?
Heck yeah. Or whatever, if you have more.
No, I've got a couple more if you want to do that.
Yeah.
Okay. Well, how about you translate, let's see here, Medicare versus Medicaid?
Never heard of it.
Oh,
no, I'm just kidding. So Medicare and Medicaid. So Medicare is health insurance given to every U.S. citizen upon attaining age 65. You get to 65, if you're still working, you can say, hey, I want to use Medicare. If you're retired, switch to Medicare. Your healthcare costs drop precipitously. Beautiful. Love Medicare. Medicaid is for people who don't have money. So if your income is really low while you're working, and I don't know the numbers, I want to say 30,000, somewhere in that area, you can qualify to get Medicare below age 65. They call that Medicaid. The other time Medicaid comes into play is if you are in a nursing home and you're spending your assets down to pay for the nursing home. When you get your assets down to $2,000, then Medicaid kicks in and pays for long-term care. So Medicaid is not something really anybody wants to go on. It's a backstop for people.
Okay. Simple enough. Well, sort of.
Yeah.
Okay. Let's leave it at this one too.
Okay.
I think this is a good way to finish up the show here is translating income planning versus investment planning.
Good. We talked about this earlier in the show, right. So I think this is a good way to wrap it up. So growth, distribution, or income planning. During your growth years, maybe you're not worried about interest or dividends. you're probably not worried about risk as much because you have a long runway. You're 30, you have 35 years. You're 40, you might have 25 years. And it's not guaranteed, but typically stock markets over a decade or 15 years are higher than they were 15 or 10 years before. So you have volatility in the short term. So markets are going to do this, right? Mm-hmm. But over the long term, stock markets typically rise. It's not guaranteed. That's typically what happens. So when you're younger and you're going through that growth phase, you're not worried about risk as much because you're not spending the money. So if you have a down year, you should be excited because you're not taking from the portfolio, you're adding to the portfolio. And you want to add to the portfolio at the lowest cost possible. So when the markets are down, that gives you the opportunity to buy those same shares of funds or ETFs that you bought a few months ago at a lower cost. And when markets come back, you have more money. So volatility is awesome when you're investing for growth over the long term. Volatility sucks when you're retired. Yeah. Especially if you're spending that portfolio, it can really eat away at the value of that portfolio. So you want to make sure that as you get closer to retirement, you want to reduce the risk in your portfolio. But here's the issue you have to balance with that. We're living longer, Doug.
Yeah.
So let's say you're lucky enough to retire in your early 60s. You could retire for more years than you worked.
Hopefully,
yeah. So you can't just put the brakes on growth and say, I'm just going to spend my portfolio. So that's where a planner comes into it, where they say, let's bifurcate these assets. Let's have some growth assets. Let's have some income assets. And let's make sure that the whole portfolio is outpacing inflation while at the same time we're giving you the income you need that's also outpacing inflation. So we have to really run some complicated numbers to figure out how to do that. That's why I created the most advanced financial planning tool in the country that allows me to do those numbers immediately and tell you within a few minutes, Doug, you can retire or you can't. That individual I was telling you about that was in his early 60s, I told him, don't wait till 65. You're better off retiring now. It's going to cost you less taxes to work 3 more years. So it's those situations that I love when I can look at somebody's portfolio and say, you don't have to work anymore. I can replace 100% of your income for as long as you live. It's fun. It's why I do what I do. It's why I'm going to keep doing it.
All right. We good?
So if you want that, if you're sitting there going, do I have enough to retire? What's my number? That's all BS. We talked about that before. Mm-hmm. Let us sit down with you. Let us build this plan because you're out there, you're watching. Hopefully, if you haven't hit the subscribe button yet, please hit that subscribe button. Please turn the notification bell on so YouTube actually tells you, hey, a new video's out. Check back with us every week because we're going to be doing this every week. We're going to be talking about economic situations. We'll talk about the Fed chairman coming up here in April. We're going to talk about the stock market. We're going to talk geopolitical, taxes, Social Security, everything you wanted to know about retirement. And if you're sitting there going, this is a little complicated. I don't know if I have enough. I don't know if I could save taxes. Scan that QR code. Call the phone number on the screen. Go to sequinox.com. Set up a meeting with us. If you're in the Lancaster, Pennsylvania area or the Johnstown area in Pennsylvania, you can come in and see us. If you're not anywhere else in the country, we'll do a Zoom. We'll walk you through this. We will build a full written financial plan for you pro bono. We'll build it for you and say, here's what we can offer you. And if you go, oh, I like that plan, we can implement that plan. We can update that plan for less than 1% of what your assets are that we would manage. And that's what we do for our clients. We manage the volatility, we manage the taxes, we manage the income. We handle everything so you can just sit back, relax, either enjoy the last few years of work, or if you're retired, enjoy retirement even more. So reach out to us. we're here. Make sure you check back every week because you got myself and Doug
Yep.
here to guide you and tell you everything they never told you about retirement. Thanks for joining us, and we'll see you next week.